I think the central question remains whether to buy the dip or not, because these moments, as we know, they cause volatility. We know that. They often don't cause worse, okay? So I would suggest that these moments can be, for many, paralyzing. They can also be opportunistic. What do you think?
I think, what's your time horizon, right? I think that's what investors need to ask, what your time horizon. And buy the dip, it's like we have so many sectors to buy the dip. Do you want to buy software dip? Do you want to buy financial dip? Do you want to buy the Korean dip, private credit dip? And so there's a lot of opportunity, whereas the S&P is still flat for the year. I think the equal weight's up about 5. And so I do think that, especially within software, the software ETF, all those stocks look identical from a chart, which tells me that there's a lot of opportunity there. I think also financials are another opportunity there. So I think there's lots of spots that people can go in, do their own work, and buy some individual names that have been unjustly, let's say, sold off and where fundamentals aren't meeting the actual reality that the stock is trading today.
We'll get through a bunch of the different sector moves because they are interesting today. I love the context that you put, and at times like this, context is more important than anything. The S&P's down 0.2% on the year. So we've run a lot and we've gone nowhere. What do we do as we look at the backdrop, what's happening geopolitically, and we realize that the story at home is still good? And until that changes, why would you react to something so far away, even as serious as it is?
So if you're asking me, should you panic and go jump headfirst into it?
No, I'm not asking you if you should panic.
No, of course not. Of course not.
That wasn't the question.
So,
whether you should panic.
Okay, I misinterpreted. Of course, the market looks forward. The market has been through its share of wars and skirmishes and geopolitical events, and generally, if you look a few months later, generally, it's calmed down and something has reverted back to at whatever level we were previously. So this is another example where we have sort of an explosion, literally and figuratively, that the market goes into some sort of oh my God phase. But here we are, and it's a few days later, and companies are reporting, and Broadcom had good numbers, and NVIDIA and Jensen Huang talked about where they're selling their chips and what those chips will be doing, and the software stocks were oversold, and people are buying them, and the non-software or heavy-duty industrials, et cetera, were a bit overbought, and so people are selling them. And that's the way I would interpret it.
You kind of answered my question in a sense when you talked about, unless there's some kind of, oh my God, moment, you think about what are those moments at times like this, right? Is it oil to 100? Is that okay, now you got to start thinking about the inflation picture, the ripple effects into the economy picture, and all of the ancillary things that would obviously be impacted by a spike in oil to that magnitude, the Strait of Hormuz being closed or ships actually being attacked or things that would change the calculus. My point and my question at the top is X that. Do you sit back and you say these are moments that have great opportunity along with them for long-term investors, like ostensibly most of the ones who watch our program, despite the tactical nature of some and the various things that people do differently than some others?
For sure. And this is why I love being an active portfolio manager, because I can get super granular right now. So I'll give you a great example. A couple days ago, we added 5 positions to our international, not 5 new positions. We added 5 positions from our international portfolio to accounts that don't own them yet. Because with international stocks collectively being up 40% over the last year and 3 months, we've been really hesitant to broadly just buy the whole portfolio. But you wake up one day and you've got stocks in your portfolio down 7%, and they're totally unrelated, and there's no real consequence from whatever does go on in the Strait of Hormuz. So we added Veolia, Honda Motor, Nordea Bank, Seki Sui House. And those are some great things to add when they're down 7%.
Did you tell our producers about all those so they can throw them
No, sorry.
up?
It was a couple days ago. I didn't think we were going here with international. So sorry. I didn't, and it was adding existing positions in the portfolio.
Well, I just want them to be able to put something on the screen that shows our viewers because you ran through those so quickly.
You want me to say, I'll say them again.
Yeah, do it again, please.
Veolia, Honda Motor, Seki Sui House, Nordea Bank, and DHL was the other one. So it's nice to be able to take advantage. And then in the equity income strategy, I said, okay, who doesn't own Columbia Bank shares? Because that company is fine. So you can pick off and see where there's opportunity. But I like it too, in that you do have opportunities where, last year, if you look sector by sector, it's pretty bifurcated. This year, I feel like it's even more severe. So you've got consumer staples up 13%. You've got consumer discretionary down 4% on the year. Within all these sectors, there's enormous rotation and movement. Now, I'm not super heavy on the software side, but within the software space, if you know that space really well, like opportunities being created there. I can't tell you which ones are new and exciting today, but if you know that the way we know international, you can buy things.
I think some things are unanswerable at this moment. I think people can think that they know about software, but I would suggest to anybody who says that they know doesn't know, because it's almost impossible to know what the disruptive force of all this AI is going to be on software companies. Some are going to have a severe problem, and they're going to be severely impaired. Others may not. We're still trying to figure out who's who and which bucket each of these companies falls into.
I think within software, Robert Smith, who founded Vista, right? He founded, he's been there forever. He put out a video the other day. I thought it was very, very, very logical. And he made the point that, yes, is seat-based going to have to change, right? Because let's just take that as we're going to have less seats
less
with more
seats
productivity.
with more agents.
So then he would say, well, I think that because this does cost to do compute, we go then to a work-based, where you have now, instead of 10 people, you have 5. Those 5 people are doing more work. Guess what? That work costs money to do the compute. And then in addition, I think what's so fascinating is he said that less than 1% of enterprise data, like the data at my company or the data at Exxon or have you, is actually being trained inside of AI right now. It's really just the internet, and that's the opportunity. And I do think that, yes, maybe these software companies, the multiples going forward just need to be lower, right? They need to be lower.
Well, that's what's happening now, right? They're re-rating for a rethink on where the revenue growth of that industry is going to be 5 to 10 years from now. That's the whole point of the pullback.
Right. And so the point is that I think the narrative does get a little disconnected to potential future fundamentals, because when you listen to Salesforce earnings, which once again, I bought it, I sold it, because I just can't get my arms around like these questions we're asking. But I do think when you listen to these software companies' earnings, they are still doing very well. And so if you put a lower multiple on them, they're not going to zero. And so that's where, like, I own a Zoom. I can get my arm around Zoom all day long. I think there's not that much downside. I think there's good upside. But you have to do that individually, because I said at the front of the show, all of those stocks, the charts look identical, and they're totally different companies.
The question is, Jonathan Krinsky put forth the other day, is whether the software stocks that have been down a lot are washed out. And you've seen some stability in the space. As we know, the IGV is up 7.5% in a week. Cyber's having a great week. Palantir's up. Bryn was just talking about some SaaS names like Salesforce. Snowflake's up. We've watched ServiceNow. All these names that we have talked about on such a consistent basis, and frankly, most of it negative. Is it bottoming, do you think? Because Microsoft, if you want to throw that in there too, look at the chart. We show it every day. Pull a year.
So this is exactly the question that we felt would be important to answer. Let's compare the old economy stocks that have been surging with the new, I'll call it the new economy stocks, even though Microsoft isn't new, but including some of the others. And we have a chart here that shows that the current, this is old economy stocks, and I had a bunch of them in there, names like Caterpillar, Deere, Emerson Electric, Flowserve. This is where the forward PE of these stocks for the group, the average was 30 times, and giving them the benefit of good earnings growth, we look at 11+% this year and 17+% next year. Then we looked at how are the new economy, the software stocks, such as where are they trading? 21 is the PE. So these stocks have come way down in PE and their growth rate. And these are numbers that I reduced from estimates that we had been using, and they're still growing faster than the old economy stocks. So I don't know whether the run-up was too much. It certainly was fast, or the run down too much. We know it was fast, but it appears to us that there is now this sort of disequilibrium where there's too much buying in these stocks that are cyclical, really.